Hi, everybody. Good evening, good afternoon, good morning, wherever you are in the world. It's Thursday, Financial Thing, live stream. Hope you're having a great week. Glad you're here. Thank you for joining. I hope you also enjoyed last week's live stream with Jan Murciano, CEO of Blend Network. I thought it was a really good stream. I really like having Jan on. He has a lot of smart insights into the world of not only peer-to-peer, but also just lending in general. Um, as Jan mentioned, peer-to-peer lending has really evolved into more than um, private person to middleman to borrower. And while the industry itself has shrunken in ways, many ways, while the bad is cleaned out of the system, I think a lot of good things have happened. And I had an email this week. Somebody asked me, do I think peer-to-peer lending is dead? And it was an interesting question because from my experience being in this sector for the last, what are we now, 8 years? I've been doing this since 2000, late 2015, early 2016. There's really two sides to the story. On the one hand, you have the original, I call them OG investors like myself, and also some people that have been doing it a lot longer than I have, probably since 2008, 2009, 10, through the likes of Zopa. But some of the old OG investors are the ones that think peer-to-peer lending is dead. And on the other hand, you have the new passive investors, which is a smaller pool of people because they've come in later, but they see a really, really bright industry and a bright sector of peer-to-peer. And it's very interesting talking to the two different sides because you have the ones that have been burned, by the likes of the the Lendys and the house crowds, the Wellesley and Co's, the funding secures, list goes on. And then you have the new generation of peer-to-peer lenders who have seen nothing really bad happen to their portfolios. They've been investing in loans through LoanPad and Blend Network, PropLend, some cases Cufflink, and Easy Money, and they've had generally a really good ride of it. So when I've been asked, is peer-to-peer lending dead, it could certainly appear that if you were an old school investor, you might look at it as, yes, I'm getting my money out of it. I don't want to get burned anymore. I don't want to have any more bad experiences. But then you could look at the new investor who is eager and says, well, yes, I can get 4.5% in the bank, but however, that interest rate is going to be decreasing. Even if it's just temporarily, I think bank interest rates will come down. And probably go back into the 3.5% range, even if it's temporarily. And then what that's going to do is it's going to make certain peer-to-peer lending investments actually look really enticing at 6.5%, 7%, 8%. And that's when people, I think, will start to maneuver away from the secure side of bank interest rates into peer-to-peer lending again. So there's kind of this ebb and flow within investing. When interest rates are high, people gravitate to the safety of savings accounts. But when interest rates are poor, which is what happened when we saw this big influx of money come into peer-to-peer, interest rates were just marginal, right? About 1%, 1.5%. People didn't find that attractive, so they took more risk, went into peer-to-peer lending. And I think that you're going to see that again happen in the future when those interest rates do start to come down. Also, really interesting, when I was talking to Jan last week before the stream started, he said, what do I talk about on the stream? And I said, well, generally it's really a peer-to-peer lending focused stream. And he said, do you have enough to talk about? Because there's just really not that much going on in the sector at the moment. We're not seeing any big growth in the sector. We're seeing some of the original peer-to-peer lending companies that we talk about that have continued to do well. but he did say, "Yo, well, what do you talk about for an hour or for 45 minutes?" And I was thinking about that, and I thought, you know what? Whether or not we have really anything to talk about here for this short period of time that we get together once a week, I don't do it for the peer-to-peer lending news. What I do and why I created this financial thing website to begin with is to kind of create a community of people and like-minded people who perhaps wanted a place to come and be together for 40 minutes or half an hour or an hour every week to vent, to make comments, and just to be together. So that is kind of also my focus going forward because, as the peer-to-peer lending sector kind of stagnates as it is at the moment, we may not have a ton to talk about exactly about peer-to-peer lending. And I certainly don't like always focusing on the bad news. And it seems like because of all the administrations, there's just so much more bad news than good news sometimes within our sector. I just don't necessarily want to focus on that. But I do want to have a place, even if it's half an hour, 45 minutes, to come every week where you guys can come and kind of be together. So a little rant over. Anyways, thank you for being here. A quick hello to our sponsor shout out, Cufflink, of course. Generous sponsor of the show. Earn up to a 9.83%. Actually more. They're doing the bonuses at the moment. That is gross interest per annum. I think there are over 300 million of property-backed UK investments now made since 2016. Zero investor losses to date. Remember, your capital is at risk. Don't invest unless you're prepared to lose money. This rate of interest can change as interest rates do change. You can sign up at the link below if you haven't already. join.cufflink.com/financial-thing is the sign up. Thanks again to Narinda. And as a side note, next week on Thursday, 21st of March, Narinda will actually be here. I know we've been promising this since September of 2023. Unfortunately, him and I both had to reschedule a couple of times, me because of what happened with my mother and her being ill, me having to go back to the UK. And then Narinda had scheduling conflicts, but he's going to be here next week. So bring your questions. I'm sure he'll try to answer whatever he can. I'm going to be asking him certainly about this, any late loan situation, also what's going on, what was the decision-making process, moving the minimum investment amounts up to those higher amounts. Those are the main questions. But if you have any questions, you can either email me at help@financialthing.com or go on the website, fill out the contact form, or just bring your questions here live next Thursday. It'll be at 7:30 p.m. UK time, which is going to be, I think, 3:30 p.m. US time, Eastern, where I am in Orlando, where it is right now a very balmy 28 degrees. I am hot. Don't mean to annoy you by saying that, but yes, it's hot also. Anyway, quick hello to everybody who is here. Quick hello to Harley, who is having a snooze, sponsored by Cufflink. That is the Harley cam to prove she is actually a real dog. Somebody did ask me if she's actually my dog. Yes, she is. But quick hi to everybody. If you could hit that thumbs up, it is most appreciated. That's the only thing I ask of everybody in the stream. Jimpo Naughty is here. Mark Mason is here. Dave Dawson, Colin Perry in the Peak District. Paul Bagworth is here. Peter Vince from Leatherhead in Surrey, as always. Alan Stratford is here. Stephen Hale in Nottingham. Paul New in Stockport. Mike Powell, hi to you. Aki Chap is here. Hello from Accrington. Lionfish hunting in the sunny Cayman Islands. 30 degrees centigrade for you. I know, it's very hot. You're kind of in the same vicinity of the world that I am in the tropics. John Day is in Nottingham. And yes, Mike Powell, you are a newbie. No, I know you're not a newbie. Certainly not. What are we going to talk about today? We're going to have a quick look at LoanPad, what's going on there with their statistics. I always like to keep an eye on that. We're going to do a little bit of peer-to-peer lending news. We'll take a look at Prop Lens statistics, Blend Networks, Property Pulse. We're going to talk about the ISA changes because we are coming up to the end of the ISA period in April where you can put your money into ISAs, talk about what the changes are for 2024, take a look at the Trading 212 portfolio, and also answer a question about the stock market right now and what is going on with that. Bitcoin also doing very well at the moment. So hopefully hoping to be 35 minutes today. We'll see if we get through 35 minutes. But again, thank you for joining. Let's get right into the LoanPad statistics. LoanPad's still continuing to be the slow and steady horse in the peer-to-peer lending rate. Now they have 80 million pounds of total lending partner loans and 88 million pounds in total LoanPad loans. Average loan to value 42%. 197 loans, an average loan size of 447,000. Total lenders, this has definitely upticked as time has gone on. It kind of slowed down a little bit to where I think it got to about 3,500 and then really started to take off again. Average lender has been lending 16,600 pounds on average. 16 lending partners still. Interest coverage size 42,322 pounds, which nothing of that is being used at the moment. I really kind of see this as a kind of insignificant number, to be honest, because it's such a small interest coverage fund that, yes, it's there to be used, but it doesn't really seem like it needs to be used. So that they have very good servicing of their loans. We've had a total number of LoanPad loans. Remember, this is since 2019. So LoanPad now going on 5 years of operation. 604 total loans. Look at this, 407 loans repaid for a total of 234 million pounds of total loans since 2019. 146 million and a half total repaid LoanPad loans since 2019. So really good statistics from them. And also this number, which has never changed. And if you can imagine, in 5 years, these estimated time to sell, estimated time to invest, 1 day. I do get comments about this £10 minimum that the system needs to reinvest money. Somebody asked me on email this week exactly how long does it take to get £10 of interest on LoanPad. Well, if you're in the 6.5% 60-day access account, say you've got about £3,000 on the LoanPad platform, which is way under the average lender amount. You're looking at about 18 days to get £10. So every 18 days, you can be getting £10 of interest that will go back if you want it to go back onto your original balance for compounding interest, or you can take out that £10 if you want. So if you've got obviously 16,000, which is the average lender amount, it's going to take you far less than 18 days to get £10 of interest. I haven't done the calculation on 16,000, but let's see, I don't even know what that number is, but it's probably just a couple, maybe 3 or 4 days to get £10 on 16,000 pounds of investment. I'm certain that eventually, and coming up not too long of a distance away, that £10 minimum will come down, hopefully to less than £1, so everybody will get their interest reinvested very quickly. But right now it hasn't happened yet, but it is coming. I know it's coming down the pipeline. Also, LoanPad, they put up a couple of interesting articles on their blog. If you haven't read them, they're really good. It's one of them is entitled "How We Reached Over 80 million pounds." It says it was launched, in 2018, not 2019, so coming up on year 6. But basically what the article says that LoanPad has really been from word of mouth. They have done a little bit of advertising in places like Financial Thing to kind of generate that interest, but most of their business has just come from families, personal families, word of mouth, and it's really picked up from there. And they don't have any investor losses to date, which is something that not many platforms can actually claim that they have. There are a couple that do have 0 losses to date, but not many. There's not many of them. And then they hit the £100 million milestone on their loan book, which is super cool. They grew organically, so it's a pretty interesting. It's a pretty interesting article. So they make a mention here of having a loan book that is actually manageable size. Saying here, if we wanted to be a £2 billion loan book in a year, risk the integrity of the business. That's not what we wanted to do. So they want to kind of grow at a steady pace and not too large. There comes real problems if you are a peer-to-peer company and you grow too quickly. You have terrible issues when it comes to staffing. I've noticed that, and this is really interesting, but if you look at all the very big peer-to-peer lending companies that have big staffs, they were the ones that really either end up closing to retail or just closing down because their expenses were so high. But companies like RateSetter, Funding Circle, which is actually in the news too, Assets Capital, large staff, large overhead, big payrolls to kick out, and they grew so fast that all of these growth issues, I think, started to catch up with them and maybe create some internal issues. So LoanPad didn't want to do that. They wanted to keep things small staff, keep things really manageable, and to grow at a steady pace, but at a manageable pace. Also, there is another news story in their blog, which was put out a couple of days after that one, which is, I think, is a really interesting story about how does LoanPad earn its money. And this is a question that I think should be asked to peer-to-peer lending platforms in general, because a lot of people really don't understand where their money comes from. But there really is only two ways. Number one is origination fees. So if a peer-to-peer lending platform is originating their own loans, which some of them do, some of them don't, but they can add percentage fees on the front end to the borrower, and those can be quite hefty, sometimes 5 to 10%. So imagine if they're lending out £1 million and there's a 5% fee. That's a £50,000 fee. That's how they generate their revenue. But other peer-to-peer lending platforms, and this is what LoanPad does, is they charge a spread. So if they're lending at 8%, they'll go ahead and pay investors 6%. So people like you and I, 6%. And they're going to take that 2% spread themselves, which is fair enough. I mean, these companies, they have to earn money. You can't expect them to live off of nothing. But it says right here on this blog article that LoanPad does not charge any origination fees to the borrower. Instead, the platform makes nearly all of its revenue by sharing of the interest payments made on each loan. On some loans, LoanPad may charge a small administration fee to the lending partner. We earn money right alongside our investors, explains Neil Maurice, Chief Operating and Financial Officer at LoanPad. We think that makes us more sustainable as a business, as it means we can continue to make money as long as our loan book is active. There's the question here, why doesn't LoanPad generate more of its revenue from fees? Arrangement fees are paid once at the start of the loan, and that's it. Unless the loan is refinanced, the platform won't earn any more money from it until after it's been funded. This encouraged some peer-to-peer platforms and non-regulated lenders to increase their lending activity, which could come at the cost of effective due diligence. Now, this is exactly what happened with Lendy. They were charging these upfront lending fees on the administration and origination fees, and what they ended up doing is just writing more and more loans, churning them out to generate more and more fees so they could pocket them, and eventually those loans went badly. What LoanPad is saying, they want to take percent of the loan that is coming in, every interest payment, they take a little piece of that. And that way, as long as the loan is performing, LoanPad is making money. If the loan doesn't perform for some reason, LoanPad doesn't get to make their fee, which I think is really in the best interest of lenders, because they are in the same exact place as you and I are. If the borrower is making payments, then LoanPad and you and I as investors get paid. If not, then none of us get paid, which is exactly, I think, the right way to do it. It goes on to say the issue is that we see that the model of origination fees could encourage a lender to want to lend now. There will be a subconscious view that you need to lend in order to make money. Hello, Lendy. So if your entire revenue is built off arrangement fees, if you don't lend, you don't make money, you can't pay salaries, you can't keep the lights on. If the loan goes sour in 6 months' time and it goes into default, the lender will be able to keep their arrangement fee, and the people who lose out are the investors. LoanPad looks at things differently. More than 95% of the company's revenue comes from its net interest margin. For example, if we lend out a loan at 8%, we'll pay our investors 6%, and we'll take that 2% in the middle. The result is that we don't have an incentive to go into a deal just to make money up front. We only make money throughout the whole term of the loan, along with every other retail investor. So if a loan goes bad after 3 months and the borrower stops paying, LoanPad also stops receiving its interest. Really good. This is exactly what you want to see. I think this is the best way that a peer-to-peer lending company can do. And I also love the transparency that is written right there in the blog, and you can see exactly how LoanPad makes its money. In the news, UK peer-to-peer lending market revenues forecast to reach record high. This is an article from March 13th, 2024 in the accredited alternative credit investor. Very interesting because, as I said before, it does feel like the peer-to-peer lending sector in itself is kind of stagnant at the moment. It doesn't seem like there's much going on. However, the market revenues are forecast to reach a record high. Data research from IBS, IBIS, not IBS. That's irritable bowel syndrome, which is the first thing I saw when I read that. Data from research firm IBIS, analyzed by peer-to-peer lending money easy platform Easy Money, found that peer-to-peer markets annual revenues collectively grew by 1.6% year-on-year to £376.6 million in 2023. IBIS World is now forecasting a 5.6% year-on-year increase to a little bit less than 400 million on annual revenues in 2024. So if you go back to 2013, when the sector collectively generated revenue of just £20.2 million, it's a pretty significant growth. However, £400 million of revenue is very, very small if you consider the whole sector of general finance in itself. And just imagine, for instance, the market cap of Bitcoin now is $1 trillion US dollars, so 397 million of revenue. It's still a large amount, but still relatively small in the grand scheme of financing in the finance industry. But that does show some impressive growth, and I think it is a really good piece of information that we do want to see the peer-to-peer lending market actually continuing to grow. We don't want to see it contracting. Now, on the flip side of that, Funding Circle is offloading its U.S. business after losses widen. Remember Funding Circle? The company, one of the big three, Zopa, RateSetter, and Funding Circle were the original big three. And now Funding Circle has had losses within its U.S. business, and it will be offloading its U.S. arm to focus on its more profitable UK business. Group losses widen year-on-year, reaching £33.2 million in 2023, compared with a pre-tax loss of £12.9 million the previous year. So Funding Circle showing that their business over in the US is not sustainable, and sometimes these companies look at things and say, it's time to get rid of it. They're also talking in this article about Funding Circle's UK FlexiPay solution. I didn't really know what that was, but it's pretty interesting. It's a way you can pay bills or expenses by card or transfer directly to a supplier, then repay them in monthly installments. So it's basically Funding Circle is giving a FlexPay card, which allows you to pay a business bill that you have, and then you can repay it in monthly installments. I don't know what the interest rates on those things are like, but likely not terrible. 3.9 to 5.9% per transaction. So, better than using a credit card or a bank line of credit that might be 7 or 8%. European peer-to-peer investors tilt older. When I saw this older word, I thought, wow, this is going to be old, right? And then the article goes on to say the average European peer-to-peer investor is now 37 years old. As more middle-aged consumers seek out higher risk investment opportunities. Wow, I felt old, being 51 years old when I saw that. I said, wow, older, 37 years old. A new analysis from Croatian-based peer-to-peer platform RoboCash has found that since 2017, the average peer-to-peer investor profile has changed significantly. 7 years ago, the average investor was just 29 years old. I think, obviously, the reason behind that is I don't think there's a lot of new people and a lot of new young blood coming into peer-to-peer lending, and maybe it will, I think, as time goes on, but European peer-to-peer is a little bit different, certainly from the UK. And I would imagine in the UK that number is definitely older than 37 years old. I'd probably say 40s, 50s would be your average age. And plus, we are the generation that was in it from the mid-2000, 2015, 14, 13 onwards, kind of the older generation. So I wasn't really surprised to see that. RoboCash found that the most profitable investment projects are typically chosen by older peer-to-peer investors aged 70 or older. On the other hand, younger people are more inclined to live here and now and choosing investments with a quick payback but lower returns. I was surprised. I really thought that would have been the opposite. I would have thought the young people were more willing to take the risky projects, and the older people would want the less risk, quicker payback, lower returns. So obviously, it's quite the opposite. Very, very interesting. Easy Money finds UK investors bullish on 2024. Of course, Easy Money, the peer-to-peer lending platform that I've been trying to get on the stream now for over 2 years, and I've had not much luck at the moment. So if you know anybody over at Easy Money, I think Jason is his name over there. Yeah, Jason Ferrando. Jason, come on the stream. I want to talk to you about Easy Money. I'm very interested in what's going on over there, but he has yet to want to come on the stream. Let's get him on here. Email him. Bug him until he comes on. But 69% of private investors are confident of receiving good returns in 2024, with ISA cited as the most popular product. Peer-to-peer lending property platform Easy Money commissioned a survey of 1,305 UK investors to gauge their outlook for this year. And given their confidence in the market, few investors are planning to downsize their portfolios. Just 12% of respondents said they have any intention of reducing their portfolio, while 61% plan to keep it the same. 28% plan to invest more this year. Since we are coming up to ISA time in April, this is quite surprising. However, only 32% of investors said they've maximized their tax-free ISA allowance ahead of the April deadline. Cash ISAs proved the most popular, used by 63% of investors, followed by stocks and shares ISAs, 32%. Why, people? Why is the cash ISA the most popular? I don't understand this thing about British people holding on to cash. It's just such a bad idea. You really don't want to have too much cash in your possession. I think now with inflation the way it is, everything being more expensive, your cash is just getting eaten away. It doesn't make any sense. Now, yes, putting it in a cash ISA is better than putting it in a savings account, but if you're younger and you have at least 5 years plus to run out any corrections in the markets, you're just better off putting it in different investments and getting it out of cash. I don't understand this heavy weight of 63% using cash ISAs. I don't get it, but it seems to be just a stuck way of habits, of habitual investing that's just been a way of life for a while for people. But I hope that one day changes and we see it much more weighted to things like stocks and shares, peer-to-peer ISAs and stuff like that. Less people using cash ISAs, or at least splitting between the two, which you're going to be able to do in April 2024 too. Let's look at the house crowd. they are moving into liquidation. The house crowd is moving into creditors' voluntary liquidation after an administration process that lasted more than 3 years. Administrator Quantuma said that it is moving the collapsed peer-to-peer lending platform from administration to creditors' voluntary liquidation to enable a dividend to be paid to unsecured creditors, which is estimated to be 24p in the pound. Look at this. It's pretty sad. Quantuma, such a hard word to say. Quantuma has returned 97,408 pounds of funds to investors during the administration. Wrap your head around that. What a small amount. And they are going to look to distribute the final 4,872 pounds. Yet, look at this. Quantuma's time costs incurred in the administration come to 1.127 million pounds. So they've done really well for themselves. They've gotten more than 10 times what Quantuma has returned to actual investors so far. 10 times that amount has gone into the pockets of the administrators. Very sad. Kind of tired of seeing these stories, to be honest, but it is what it is. Yes, by the way, just a quick word about crowd property. I spoke last week about how there was a lot of late loans in the portfolio. I did reach out to Mike Bristow, and I actually asked him, I said, hey, Mike, is everything okay at crowd property? People have been asking. I want to know what's going on. He said, yes, rest assured, everything is fine. Things are operating as completely normal. He said, yes, there has been a larger amount of loans that have been extended or late. But I said, well, why are people saying in their portfolios that they're seeing a more weighted percentage of not defaulted, but late loans than performing loans? And he said, well, and look, I'm just giving you the message. I don't know if this is true or not. I can only go off of what I hear. But Mike said to me, it's because a lot of people on the retail side have paused their investing until they see these loans catch up, and that once loans that are performing do get paid off, what happens is the percentage of people's portfolios then become more heavily weighted to loans that are becoming delayed because the ones that are paid off are out of their portfolio and they're not taking on any new loans into their portfolio, so it doesn't look as good. Be that as it may, I said, okay, please come on the stream. I want to talk about this more. So he has said that in April, so next month, he is going to come here live, and we're going to talk about crowd properties situation, see what's going on. He said everything is operating as normal. There's obviously they are, trying to do their best to get these loans caught up, but it is property lending. These things do happen. He also said to me that they've taken on quite a lot of institutional money, and if institutional money didn't believe in their business and their business model, institutional money would not put up what they have and the amounts that they have. So rest assured that those institutions have done their due diligence on crowd property to make sure that that business is being run well and that everything is okay and all well and good. That's what he said. So I can only bring you what I'm told, but that's what I've been told. I hope it's the truth. I hope everything is going well at crowd property. We don't really have anything to worry about. They also put out on Crowd Property's website an insight state of the market for February of 2024. Why is this not zooming in? Zoom in. No, I don't want to mess it up. But basically what they're saying is that the demand for housing is continuing to stay very steady because of the lack of housing in the UK. Prices are stabilizing. We've had a bit of a dip down. You can see here in the Halifax House Price Index that August to September of 2023, we had this bit of a dip on the annual change, but we've seen starting to rise back up again. The fact is the matter in England and the UK that there is a lack of housing, and it's going to continue to be that way, as it was not really addressed in the budget recently, anything to do with increasing housing growth and how they're going to create more housing. That was not addressed. So property prices again continue to really stabilize and rise. And then we see this house building decline continue. So you can see the graph kind of going down here, boom, 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 boom. So we're not seeing any real increase in house building, which is not good as far as supply goes. So demand is high, supply is low, and what that means is borrowers need to borrow money, which is what these peer-to-peer lending companies do. They need to lend money to these house builders. So that's going to be good for the peer-to-peer lending sector in general. I don't know if I read these figures before, I couldn't remember, so I thought I would just look at it again. PropLend sends out these updates, usually about their loan book, every once in a while. Again, I think PropLend is a company that is doing some good things in the commercial side of lending for commercial properties. They've got a total of 79 commercial mortgages, 78 are paid monthly interest, so are all good. One is from the interest reserve, so that would be considered a loan that might be behind or in trouble, but 98% paid. And then we have one bridge and VAT bridging loan that looks like it's being paid from an interest reserve too. This says one loan past term. It's very interesting that this loan of a VAT bridging loan. So my dad always told me, stick to what you know in business, and they kind of ventured off into this VAT bridging loan, and that one has not really worked out as far as I can see so far. Hopefully they will get it back into good standing. And then we see Blend, they put out a property market state. It's kind of a state of the union for February. Again, they talk about exactly the same thing, that the demand for housing is high, the supply is low, which is why companies like Blend are going to continue to do really well. There's a nice picture of a JCB. It's saying budget 2024 was a missed opportunity where they didn't really address anything to do with the house prices, but they did reduce the capital gains tax on properties, which is due to decrease from 28% down to 24%. A plus 25% rental growth forecast between 2023 and 2026. We have a 3% brighter outlook for UK property prices. Northern Ireland will be a little bit stronger, plus 4.5%. So that's what the annual growth is expected to be. What does this mean? It just means that peer-to-peer lending companies who are focusing on property are going to continue to need and continue to have good demand from borrowers, which is good for you as an investor, because it means there'll be places for you to put your money for loans and whatnot. Let's talk about ISAs. There's a couple of changes, important ones, that are coming up. Number one, this is a big one. Savers are going to be able to open and pay into multiple ISAs of the same type each tax year. So before, they had this stupid ISA rule, whereas if you wanted to open an, say, a peer-to-peer lending ISA, right, or stocks and shares ISA, you can only open one new one with the one single company every year. And I think that really stunted the growth of IFISAs, because people didn't want to put their entire £20,000 allowance into, say, one peer-to-peer lending company. They like to spread their money around to diversify. And now, if you want to open up 10 different IFISAs in one tax year and put in $2,000 in each one, you're going to be able to do that now. You just have to make sure you keep good records of doing that. And that's a really good rule change. It's about time that they allowed this to happen. Minimum age for cash ISAs has been raised now to 16 and 17. So it's been raised from 16 to 18. Not really sure. I don't know how I feel about that. The partial ISA transfers are allowed from April the 6th, 2024. ISA savers will be able to transfer part of their balance from one ISA provided to another, regardless of when the money was paid in. Under existing rules, customers have to transfer their entire ISA of that type from the current tax year or nothing at all. So that means you're just going to have a lot more flexibility and do whatever you want with your ISAs, which is the way that it should be. Innovative finance ISAs were launched to help provide a boost to the peer-to-peer lending industry, but they remain a niche product, only accounting for 0.13% of ISAs, according to HMRC. For the next year, the range of investments will be expanded, with long-term asset funds and open-ended property funds with extended notice periods allowed inside IFISA. So yeah, the main one there, obviously, that really applies to people who invest in peer-to-peer lending is you'll be able to move your ISAs much more freely now, and also open 5 different ones in a year if you wanted to. You want 5 different stocks and shares ISAs, you can do that. You just got to make sure you keep good records of that, because if you don't, and HMRC comes after you, you're going to have probably a pretty big headache, because that could be super, super annoying. Let's take a look at the Trading 212 portfolio for anybody that's been following along for the last, God knows how many amount of years. Has it been 5, 4? I don't know. I can't remember now. Anyway, here's how we're doing. 19,860 pounds. We were up 20,500 at one point. Unfortunately, Coinbase took a bit of a drop today, 7% in the red, and also Mr. Rivian has not been trading as well. We're down almost 30% now on Rivian stock. They had an announcement they're going to be releasing a much more cost-effective electric vehicle, which was very bullish. You can see here we got a bit of an uptick in the stock when that was released, but then since then things have kind of taken a turn for the worse. But this for me is going to be a long-term hold, and for now at least, unless I need the tax write-off of the loss here. So we'll see what happens with that. Another position that we added was Valco Energy, and that has been actually quite good. We got in at $4.49, £3.56. We're now at $5.34. We had a big jump today of, how much was it today? Look at that, 19.73%. After they released earnings that were very, very positive. So a bit of a fallback there. So that's been decent, 17% in the green. And then we continue to still be in the red. Green Power, 53% and in the negative. And then Vermilion Energy, 42%, continues to be a bad dog. And then Deutsche Bank finally is moving in the positive, now up about 22%. So we've had a good run. Bank stocks, tend to be really kind of boring stocks. You get a bit of a dividend on them sometimes, but they're just not innovative. I think when you're trying to really go for more high-octane power stocks, bank stocks are just not it, right? They're really designed to balance out a portfolio if you're trying to pick stocks, which I never recommend. Just go for the index trackers. But bank stocks are just not innovative. How innovative can you be with lending? What are you really providing? I give you money, you give me interest. It's never going to really change. I don't think you're going to see any real innovation. But going back to Coinbase, we've had a really, really good run. Our average price in was $128. So now we're at $233, and we were very close to 100% returns on that stock. So we just happened to get in right down here at this low point. In the 120s, which is good. Might be the first time I've nailed the bottom in a while. And I have sold some of those stocks on the way up to learn not to be greedy. Very important. You can see here, we sold 4 stocks on March the 6th. We took the profit of 342 and then sold on March 4th too. Took the profit of 210. So now we're just sitting on more cash waiting to see what happens. We had a bad day too with Alibaba today. That's not been a good day, almost 4% in the red. So valleys and peaks with these damn portfolio shares. It's just very difficult trying to do any kind of trading. Whenever you think about trading stocks, if you're ever interested in it, you always remember that you are you are trading against another person who probably has more knowledge and more skill than you do. Somebody's going to win, somebody's going to lose. I've been lucky in some cases with this portfolio. If you imagine, it started at 5,500 pounds, but I think a lot of that has just been pure luck through that huge growth of 2022 when you just couldn't mess with stocks and most things were just going up. Best thing to do, stick to this index tracker. I keep harping on about this because it is so true, but I trust the old Vanguard stock is just been going on the up and up from 2011. One of the biggest things that people ask me right now is they're just fearful of buying in because the price is too high, right? Everything is high right now. Everything is at its top. But if you zoom out and look at these graphs and these charts going back to 2010, you're going to see that there was always a high point. Wherever you look at it, there was always going to be a high point where if you ignored buying at these high points, you just missed out. Look at this. This is a high point right here in 2012. We had another high point here at 2013. One here, one here, one here, one here, another one here, and then just keep going on up. Now, again, if you zoom out, you're going to see that those historically high points have always been overtaken by another high point. And if you sat out and waited and waited and waited, probably you're going to miss some really good opportunities. Right, and that's the problem. A lot of people sitting on cash, they're too afraid. They don't want to buy at these high points. But as long as you keep a long-term approach, I think everything is going to be fine. You tend to see whenever there's corrections in the market, you tend to see pretty big spurts of growth quite quickly afterwards. So just sitting on cash waiting, like, I'm doing it in this trading 2-on-2 portfolio, and the problem is I end up just sitting and sitting and sitting. I've been sitting with a bunch of cash in here now for months and months, not knowing and not feeling really confident about entering and coming back in because these prices are high. And that remains a emotional issue of not knowing when to go back in. If you look at these prices, hopefully you can see that. Look at this going back to 2017. This Vanguard tracker was at $3.99, right? And you go back and you just look at the prices. Sometimes they fluctuate a little bit up and down, but go back and back and back, and you just see those prices continuing up and up and up and up and up. Now, not to say there won't be a correction, right? There absolutely will. Right now we're at 800 and something pounds, 894 pounds. This could drop 10-20%, but long term I do believe that it will continue to raise up if you can just hang in there for a long time. We've had a 52-week low of 703 pounds, a 52-week high of 890 pounds just on this index tracker. So that's just the easiest way to invest, I believe. You have to be able to stomach these highs and stomach these lows. And timing what is the old saying? Time in the market is better than timing the market. Hey, if you've got a crystal ball like this one, you're able to time, more power to you. I've never been able to get it right. I've gotten lucky a couple of times, like with the Coinbase, but most of the time I'm on the wrong end. Most of the time, when I'm trying to time the market, I'm hitting these Rivian disasters 28% down, Vermilion 43% down. Imagine if you were putting 9,000 in instead of 900. It'd be a pretty big loss, seven grand loss. Anyway, you get the point. You get the point. This is really a message for those of you out there that are not really familiar with investing, who are a little bit scared and sitting on the sidelines. Slow and steady wins the race. Invest a little bit every month, what you can afford. Just keep on going, and hopefully one day we'll all make it out of here. We'll see what happens, okay? Anyway, let me take a read. How long are we going for? 40 minutes, 50 minutes. Long enough. Okay, let's take a look at your comments. Don't forget, come back next week. We'll have Cufflink here live, 7:30 p.m. UK time, Narinda Couture, CEO of Cufflinks. Cufflink challenged by a lender over transparency issues. Reported bought out his loans and didn't answer complaints. I think I know what you're talking about. I did read about that on the forum. It's very interesting. Always things to keep an eye out. You know, what do they say? Trust but verify, right? Everything when it comes to investing. Stockport 12 degrees. Can you have a look at LendInvest? What would you like me to look at? What would you like me to look at? LoanPad's terms and changes. Probably the most interesting bit of news. Yeah, not too interesting, right? Evening from the Midlands. When asking about independent innovative finance ISIS to CA transfers, 2 banks had not heard of IFISAs. That's really embarrassing. Yeah, and not surprising at all. The article on the House crowd is drivel. I like that word, Mike. The figures referred to only relate to sums held by and client wallets pre-administration. The report doesn't deal with lender trust assets, only general credit estate. He's saying this is why I love you, Mike, because you have the insider information that I don't. And I'm happy to admit that. So, well done. I appreciate that. Let's see if you have any other interesting comments. I think this is the most interesting comment right now. Good afternoon from the sunny Cayman Islands, 30 degrees. Phew. I like that. Anyway. Let's wrap this up today. Thank you very much again for joining. Need to put that back on. Thank you again. Be here next week. Let's talk Cufflink next week. Let's ask some questions, see what kind of answers we get. Have a wonderful weekend. Remember, there is more to life than money. We shouldn't focus too much on that. Focus on your health and your family. It's much more fun. Anyway, I'm going to love and leave you. Goodbye from Harley, who will sleep through the weekend. And we will see you next Thursday, same time, same place. Much love to everybody. I really appreciate you being here. And that's all I got for now. Take care. Bye.